90.3 WHPC now presents Law You Should Know. The law affects every aspect of our lives, our home, our jobs, and our recreational activities. Now, learn about the law and how to protect yourself against the loss of your liberty or property, and learn how to stand up for your rights and seek compensation when you have been wronged. Your host for Law You Should Know is attorney Kenneth J. Landau, a past dean of the Nassau Academy of Law, and frequently lectures to lawyers on ethics and avoiding problems with clients, and to the public on how to choose and use lawyers. This is Law You Should Know on the voice of Nassau Community College, 90.3 WHPC.
Hi, this is attorney Ken Landau, and welcome to Law You Should Know. Today we're going to talk about year-end tax tips and also COVID-related deductions. And my special guest is Sal Albanese. He's a certified public accountant with his own small user-friendly firm here on Long Island and also with offices in Manhattan. Sal, welcome to Law You Should Know.
Thank you very much, Ken. Thanks for the invite.
Before we reach the end of the calendar year of 2020, what are some special, we'll talk about COVID later in the program, but what are some special tax planning that our listeners, whether they're an individual, a homeowner, a professional, such as a lawyer, a small business owner, can do now to reduce their tax liability for 2020?
Thanks for the question, Ken. Of course, there are many tax positions or deductions that an individual can take before the year is over to minimize taxes. I'll just go over, a few general ones. For example, deferring income is always a good tax position, and that is if you're able to defer income into the following year. Basically, what you're doing is you will defer the tax liability that comes along with deferring the income into 2021.
So if this was a sales commission or bonus or salary increase, if you can defer it till January, not receive it or touch it till January, you won't have to report it as income for this year.
That's correct. So, for example, if you have your employer who's paying the bonus, if you can convince them to pay it on January 1st, as opposed to December 31, you're basically deferring tax liability for a complete year. Yes.
What other things can someone do to have extra deductions, to maximize their deductions for 2020, and of course minimize their income for 2020 as well?
Okay. On the flip side of deferring income is basically anticipating the deductions. So, for example, if you are in a itemized deduction position, which it's getting much more difficult with the SALT being eliminated from us. But if you're in that situation, you can anticipate the deductions. Meaning what? Meaning if you're due for that doctor visit and you know that you're already over the 7.5% of your adjusted gross income, meaning if you add up all of your medical bills, for example, and if that amount is more than 7.5% of your adjusted gross income, you should plan a visit to your doctor, for example. If you need any kind of medical deductions, by all means, anticipate them. If you have a small business and you're looking to purchase some equipment, for example, buy the equipment before the end of the year instead of next year. If you have any bills, business bills that you haven't paid, and pay them in December. Date the check in December. You can mail them out. Most likely the vendor won't receive them until January. But guess what? You're a quote-unquote cash taxpayer, which means that you get a deduction in the year that you actually spend the money. So anticipate those deductions. Pay your bills before the year is over, and you'll save taxes.
Now, if you're on the other side of it, let's say you're a lawyer or a professional or someone with their own practice who's receiving money, are you better off cashing those checks or receiving those checks in January?
We need to be careful with that, Ken, and that is, remember, it's called constructive receipt. So if you're an attorney and your client mailed you the check on December 31, your client, assuming it has a business, they're able to deduct that check as a professional fee. You don't actually receive that check until January 3rd or 4th, right?
Yes.
And you're a cash basis taxpayer, that means that you will pay taxes on that fee income that you received next year. So that's the best of both worlds. The business owner who's paying the deduction, who's paying the business expense in December, gets a deduction in the current year, and the business owner on the other side receiving the income defers the income into the following year because of cash basis, meaning I received it the following period.
Now, the exception might be if you've had a bad year this year with your income and you think next year will be much better and you might be in a higher tax bracket or have more a higher profit?
Absolutely. So what we're discussing are general concepts. Of course, they need to be tailor-made for the individual taxpayer. As you know, one individual may be totally different than the next. So you need to analyze and determine what's best for you.
Are there any other expenses that a person can bills they should pay before the end of the calendar year of 2020 so they can take those deductions?
Again,
or income they can defer.
Again, general comments. My number one suggestion, and this is not self-serving, is to meet with your CPA. At my firm, I have a small firm. As you mentioned, I have offices in Hicksville, offices in Manhattan. I have 10 accountants on staff, and we go through our client list and plan with each individual client before the year is over on how to minimize those taxes. What you should do is you should take a snapshot of where you are as of today. So if you're an employee, you have a last pay stub, for example, take a look at that last pay stub. It includes your earnings to date, your taxes that they withheld. Look at your tax return that you filed last year and sort of map out or sketch out what your 2020 tax return looks like, and then plan accordingly. Of course, medical deductions are good. Mortgage interest deductions are good. So if you're planning to purchase a home, for example, if your choice is, do I close in 2020 or do I defer the closing into 2021? It may be to your advantage to close in 2020 because there are certain deductions that you're able to write off by purchasing a home, for example, before the year is over.
And it's actually the closing has to take place. You have to become the owner of that property.
Well, it's the owner, and also remember, you need to, most likely, if you're purchasing a home, you're probably financing the home with a mortgage, so you're probably making you're paying points to the lender, which are fully deductible when you're purchasing a home. You're also paying interest to the bank for a month or two that remain. So those amounts may tip you over the limit, meaning over the itemized deduction limit, where now all of a sudden you're opening up the rest of the items like the medical expenses and charitable contributions and other deductions.
So, and what's that figure for opening the door? I think you said 7% or?
Well, it depends. And okay. I'm sorry I'm so vague. There's so many different percentages and rules for in the tax code. When it comes to medical expenses, 7.5% of your quote unquote AGI, adjusted gross income. Now, what is a medical expense? Of course, doctor bills, co-pays, health insurance, long-term health care expenses, your labs, your travel to and from the doctor and the hospitals, and all quote-unquote medical related.
And drug costs, too, for drug costs or other medical related items.
Prescription drugs, yes. Any kind of chiropractor services, those are all, subject to 7.5% of income. Then, of course, the next item is taxes. Now, unfortunately, due to the last major tax legislation that was passed, especially New Yorkers, I know that most of your listeners are probably from New York, we're all faced with what's called the SALT limitation, state and local tax limitation, which means that we can't deduct anything more than $10,000 for real estate taxes that we may pay, your income tax that we pay to the state of New York, any sales tax that normally we will be able to write off. You add all those quote-unquote taxes, the maximum you can deduct is $10,000. That is major blow that we have been absorbing over the last couple of years.
But if you've purchased a house, let's say between the summer and now, you can pile on those deductions of your down payment, your other costs in buying the house, your expenses for the loan, to take advantage of that for 2020.
I'm sorry, Ken, to give you the bad news. The answer is no.
Okay.
Sorry. With a house closing, there are basically two primary deductions. The first is the interest and the points that you pay when you obtain a mortgage. The second is the real estate tax that you're paying to your county or municipality between now and the end of the year. And also there's tax adjustments that are made at closing. So don't forget to bring your closing statement when you come and meet with me or with your CPA, because there could be some deductions there that you may be leaving on the table. As far as the cost of purchasing the home and the improvements that you make and the closing costs that you're incurring, like your title insurance and your mortgage recording taxes and all those items, you need to keep track of them because those expenses end up as cost basis on the purchase of your home. So if you bought a house for $500,000 and you spend $20,000 in closing costs, most of those closing costs are not deductible, but they're added to the basis. So when you sell the house at a later date, you're writing them off at that point.
Okay, so just to clarify, if you did purchase something in the middle to late summer and you're not going to exceed that $10,000 deduction, some of those, the interest and the points and the real estate taxes, you want to maximize it to the $10,000 or whatever the limit is.
Okay, let me repeat the $10,000 limitation is on state and local taxes.
Okay.
Which include real estate tax and income tax.
I see. So it's going to be a hard battle.
Yeah, so the mortgage interest is a different deduction. Remember, another category is mortgage interest expense. So the interest that you're paying to your bank, that's fully deductible. And the points that you're paying to your bank for giving you the loan in the initial year, that is fully deductible. In addition to what is fully deductible is charitable contributions. And let's talk about that just briefly because a lot of the listeners are probably considering making them. Assuming that the overall amount is more than $24,000, that's the standard deduction for a married couple. I'm assuming that if the listeners are married, $24,000 is a magical number before you start itemizing all these deductions, okay? And if the itemized deductions are over $24,000, then you take the higher amount. If they're below $24,000, you don't need to go through all of these itemization. You just take the standard deduction. Okay, so for married couple, $24,000, the magical figure. For a single individual, $12,000. So in addition to medical deductions, interest expenses, taxes, we have charitable contributions. Excuse me. And charitable contributions is there's limitations on everything, okay? So if you're a very charitable person, you can actually this year, it's a brand new change, you're able to give away 100% of your income, adjusted gross income, and claim a full deduction, therefore paying zero tax, okay? Whereas in the past, in 2019, you were only entitled to 60% of your income as a charitable deduction. So, for example, if you make $100,000 a year in salary, for example, that's the only income you have, now you can write a check to your local church or your favorite charity, qualified charity, up to $100,000, and guess what? You'll pay zero tax.
Now, can you just pay $50,000 and deduct the $50,000?
Sure, of course. Okay. I said up to, right?
Up to. Okay. Yeah. Now, I just want to remind. We'll come back to you in a moment, Sal. I just want to remind the listeners we're talking about year-end tax tips and also COVID-related deductions. My guest is Sal Albanese. He's a certified public accountant with an accounting firm on Long Island and also in Manhattan. As he mentioned earlier, he does offer a free consultation to new clients and a free limited review of tax returns for the past 3 years. And you can hear, if you missed any portion of this program or you want to tell someone else about it, you can find the podcast at nccradio.org. I'm sorry, Sal, you were going to add something.
Yes, with regard to charitable contributions, here's a very good tax tip, okay? Assuming that you want to make a certain donation, whatever the amount is, let's say $1,000, okay? You have a couple of choices. The first, you can write a check to your local charity for $1,000. That's wonderful, okay? And you get a $1,000 deduction. Or you could donate a piece of equipment or furniture or clothing, called what we call non-cash contributions. Okay? And the market value of those, in other words, you may have stuff in your garage that the local charity may be needing. Donate those before the end of the year. Okay? You're limited to, there are certain limitations. With cash, you're limited to 100% of adjusted gross income. With non-cash, you're limited to 50% of your adjusted gross income. And the best one that I have to offer you is, let's assume you have a stock, a security. You bought it a long time ago, and you paid $2 for it, and now it's worth $1,000. You should donate that security to your charity. Now, why am I suggesting you do so? Because if you do the alternative, if you sell the security and then donate the cash, you will have to pay capital gains tax on the appreciation of that security. If you donate the security directly to the charity, you're avoiding that payment of tax, and you still get the full market value, $1,000 deduction.
So it's a way for doing good for yourself and your tax situation, as well as doing good for the charity.
Absolutely.
What are some other tax deductions that a small business owner or someone with who has a small medical practice or some other professional skill may overlook?
Okay, just very quickly, another very common is if you're in the stock market, for example, if you have a stock portfolio, and you should check with your investment advisor. We reach out to all of our clients' investment advisors to see what they've done during the course of the year. So, for example, if the market has been extremely well this year, if the investment advisor has sold securities and added profits or gains, the way I described it with that $1,000 example before, what we would do is we would suggest that you offset those gains with tax losses, meaning sell those securities that are not doing so well. Your investment advisor is be very thrilled to get rid of some of those, dog type of positions, and therefore minimizing taxes there. For a small business owner, definitely look into, before the end of the year, into setting up a pension plan, a retirement plan for yourself and your employees. A qualified retirement plan, such as a profit-sharing plan, 401k, defined benefit plan. These are retirement plans that you're able to contribute significant amount of monies. Profit-sharing plan up to $57,000 per year. Defined benefit plan could be a lot more, 100, 200,000 based on your specific situations. The key here is to make sure that you meet with your CPA and determine whether or not you need one of these things, and if so, what can you do to set it up before the year is over? Because once you set it up, then it's available to you, and you'll have until the due date of the tax return to fund it, to come up with the money to contribute, and you get a full tax deduction for those contributions that you're making.
I just want to remind our listeners that you're listening to Law You Should Know on 90.3 WHPC, the voice of Nassau Community College. We're talking with Sal Albanese, and he's a certified public accountant with offices on Long Island and in Manhattan. And we're going over some of the deductions that you can make before the end of 2020 so you can maximize your deductions and minimize your income. We're just going to take a few minutes now to talk about COVID-related deductions. For someone who's working at home and setting up a home office, having to purchase possibly new computer equipment or do extra cleaning of that house or business for COVID, what types of things may be deductible, especially in this year of COVID? Sal, perhaps you can give us some ideas.
Sure, Ken, thanks. With regard to any kind of business, first of all, whether it's COVID or non-COVID, but we'll get into some COVID specifically, there is a section of the code called Section 179, okay? What is that? I'm sure you probably heard or read about it. What it does is it allows business owners to write off 100% of the cost of acquiring any kind of equipment that qualify. So, for example, look, I have a CPA firm, so if I need new computer systems, or if I need a network system, or if I need chairs or desks or any kind of office type of equipment, as long as I purchase it before the end of the year and I place it in service, meaning it's delivered and it's placed in service, I'm able to write off the entire cost. So if you're a professional, you mentioned attorneys before, Ken. So if you're a law firm and you need this kind of equipment, purchase it. Why? Because it's a dollar for dollar write-off. 100%. It's called Section 179.
And let's say you're the worker of that law firm, or someone who has a business. You're a teacher and you have to work from home. To what extent can you, and you need to purchase these things and you need to pay for it out of your pocket, to what extent can you deduct them?
Okay, this is where the law hasn't really been too fair. So with the 2 years ago, the Tax Cut and Jobs Act, I'm sure you've heard about it. Unfortunately, the unreimbursed, quote unquote, unreimbursed business expenses that employees were once able to write off, they have been eliminated. Okay. I'm sure this is nothing new to the individuals for the last year or two. When you went to your accountant, he's not specifically asking, and they should be, by the way, not specifically asking about unreimbursed business expenses and, have you purchased a computer for business and whatnot, where in the past they used to. The federal tax law basically eliminated them. However, if you live in New York State, well, Governor Cuomo did not follow the federal Tax Act of a couple of years ago. So for New York purposes, you're able to write them off. For federal purposes, you're not. So don't cheat yourself. Make sure that you give your CPA all of the deductions, all of the expenses. Let him or her, decide whether something is deductible or not. Okay.
And if you had your own practice, if let's say you did tutoring or some kind of private educational enhancement, that might allow you to deduct some of these expenses.
Absolutely. Totally different answer. Okay. Now remember, when we say employer, an employer is a self-employed individual. So a tutor is a self-employed individual. The tutor works for a fee. The tutor will earn whatever he or she will earn. And the tutor needs to have a primary place of business, okay? So in that situation, that home office that you're referring to before, all of a sudden becomes deductible for the self-employed individual. But it's not deductible if you're an employee.
And that home office, including the cost of the space, let's say you're renting property, that the part you're using for your home office would be deductible as well?
Okay. Again, I may sound like I'm very vague a lot of times. That's because the tax law is vague, okay? So let me just go over that rule. In order to have a home office, it has to be exclusively used for business. So you may have a 2-bedroom apartment in New York City, and one of the bedrooms is converted into an office, exclusively used for the office. Remember, you can't have a bed in your office. You should have a desk, you should have a computer, it should look like an office, and it should be exclusively for the use, okay, of meeting your clients in that office. And that is your primary place. You don't have another location. Okay, teachers, for example, a number of years ago, they were able to say, "Hey, I'm writing. I'm correcting papers. I'm continuing. My work really continues in the middle of the night." However, it was determined that doing those kind of projects at home was more for the convenience of the teacher, because the teacher really had a place of business, right, at the school.
Right. So, but what about now, Sal? If someone's doing their teaching from home because it's remote learning, they still cannot deduct that space because they're an employee?
It's a very gray area. The way the law stands right now, Ken, it's non-deductible.
Okay. We're running out of time, so I just want to mention, if someone has lost their job and they're getting unemployment, whatever the assistance is, pandemic, regular New York State, or from another state, is that income?
It was always income. It will be income. It'll be taxable income, and hopefully, the individual is having some taxes withheld to offset the tax liability that he or she may incur when they file a tax return. So yes, it's income.
Okay. Give us your contact information, Sal, and your website so that our listeners can contact you for further information.
Thanks very much, Ken. Well, as you indicated before, I have a firm, Sal Albanese and Company. I'm located at 65 East John Street, Hicksville, New York, 11801. My website is www.salalbanese.com, salalbanese.com. And I have offices in New York City and also an office in West Palm Beach.
And so if a listener has any questions about anything you heard today, would like to take advantage of your free consultation, they should contact you.
Absolutely. Free of charge, no obligations. And as you indicated before, I'm able to, and I offer, reviewing the last 3 years worth of tax returns, as if I do see something there, I may be able to get refunds for you if perhaps you forgot to take a deduction.
Exactly. And that's always a good thing. And just tell us any final tips you have on dealing with income and deduction issues during this pandemic.
The most important piece of advice that I can give you is basically to meet with your professional. Do not attempt to do your taxes yourself. The tax law is very, very complicated. And as I mentioned to you before, we have different rules for the federal government versus New York State. So definitely meet with your CPA, and don't wait until the last week of the year either. The sooner the better, and make sure you're organized, go through, dot the I and cross the T and all the deductions. And by the way, just one last comment on COVID. As I said before, as of right now, individuals working from home, unless you're self-employed, are non-deductible. So the tip there is, what you should do is approach your employer to reimburse you for those kind of additional costs that you're incurring at home that you normally would write off. What the government is basically forcing you to do is to go to your employer and have your employer be the auditing firm, if you will.
And that would be deductible to your employer.
Yes, it would be deductible to your employer, but not to you. However, if you're an employer, you need to make sure that you're not opening yourself up for tax filing in other states. For example, as I said before, I have an office in Florida, one in New York City, and one in Long Island. But if I have an employee in New Jersey, for example, and the employee is asking me to reimburse for office type expenses, I may be opening myself up to file in New Jersey, in a state that I normally am not obligated to file. You follow? So be extremely careful.
And I just want to pick up on one point you said, a message to our listeners who do not use a certified public accountant for their taxes. It usually benefits them many times over. Whatever the cost of your fee is, that you will keep them on the right side of the law, and you'll help them take advantage of every possible deduction out there.
Of course, absolutely.
Okay, I'd like to remind our listeners, if you missed any part of the show, you can look at the podcast at nccradio.org. I'd like to thank our guest, CPA Sal Albanese, who has offered a free consultation to our listeners. And please join us next week at this same time for another program on Law You Should Know here on 90.3 WHPC, the voice of Nassau Community College.